then. Start the recording here. So hope you had a restful break, got caught up on some things, and ready to jump into the home stretch here as we get ready to get into the second half of our course here. Okay, so we're in chapter 12. I'm going to finish that up today probably, or wrap it up on Thursday. We'll have a bit of a don't forget your quiz 2 is on Thursday, so you have the whole day to do that, chapters 9 and 10. Okay. Okay, so that's this week. And then next week on Thursday is our midterm exam. So that'll be during regular class time. So you'll only have that window during the class to do that. All right. And so we'll have a bit of time for review next Tuesday, probably a little bit on Thursday. But again, you probably want to focus on 9 and 10. And I think 9 and 10 are big chapters. So, I mean, you can expect to see a bigger problem on capital budgeting on your midterm. So I think spending time now on 9 and 10, and then when you get through the quiz, going back to the other chapters that we've covered. So we'll go right up to chapter 12, other than the chapters we didn't cover. All right. Any questions before we get started today? Okay, well, let's dive into it. So we were looking at chapter 12. We were talking about, well, what's historically happened in capital markets. So it's good to have a bit of background in the area just to understand a little bit about what's happened in the past and where we are or where we expect to be in the future. All right. So I think we got pretty much through some of the background and information. I'm just going to jump ahead a bit here. And I think this is sort of where we ended up. We were talking about historical returns on different asset classes. So you have bonds, you have treasury bills, you have higher risk, small cap stocks, TSX venture stocks, and bonds, of course. And so we're going to talk today about how do we measure risk of these things. And in finance, we quantify risk with standard deviation. So hearkening back to your stats days, you had some, you were calculating the mean and the variance and the standard deviation. And so that's how we're measuring risk in finance. We're going to look at average returns, and then we're going to calculate the standard deviation. And that gives us a measure of the riskiness of these returns. Okay. And you can do it by hand, but I think you'd want to use a calculator or Excel. Well, if you've done it in stats, you probably used Excel for the most part. We'll show you how to do it in the calculator if you want to calculate standard deviation. Again, if you're doing it by hand or doing it with calculating, if you got 4 or 5 observations, well, you can do it by hand. It's not a lot of fun, but it's some fun, I guess. So what are you doing with standard deviation? Well, first thing you want is the variance, and because we're humans and squared things don't mean much to us, we want it, the square root of it is in the same units as we're talking about. Okay, so here's some actual returns in this example. So these are 15%, 9%, 6, and 12. 0.42 as we add those up. If I divided 0.42 by 4, I'd get an average of 0.105 or 10.5%. So there's my average. Deviation from the mean, so I take each observation, subtract the mean, and I get a number over here. And of course, if it's the mean is greater than the observation, I get a negative number here, and so on. So, and then these should add up to 0. And then I take the squared deviation. So I'm taking the deviation from the mean, and then I'm squaring that number, because if I got a negative number, I want all positive. So over here, I've squared these and got my 0.0045, my squared deviation. Okay, so once I have that variance number, I divide it by n minus 1. Okay, so if I got 4 observations, n is 4, I subtract 1, and I come up with my variance number here. Again, that doesn't mean much to us, so what we're interested in is the square root of this, and that's the standard deviation. This is the measurement of the riskiness of this investment. So what it's saying, that it varies, 1 standard deviation from the mean, so plus or minus 3.8%, and at 1 standard deviation, it's about 68% confidence that it's going to be one or the other. Okay. So I'm not going to dwell on this, but I think it's useful just as some background. I think most of you are familiar with this, but we're just going to mainly focus on how to do it on a calculator, and if for your assignment and things like that, you can use Excel. Okay, so here we have some different asset classes. So these are the same ones we've been looking at, and over we have a standard deviation in percentage. So one thing, you look at this, so this is your measure of risk, right? So the more variability on the return, the more risk you're going to have on that investment. Okay. And so you look through this list and you see small stocks, well, they're sort of up there. And then you see these venture stocks, and man, they're way up there. And then you look over at the returns, and that doesn't really jive, right? So in finance, you're always looking at a risk-return payoff. You're looking, well, how risky is it? What's my return? And unless you're a gambler, you probably are looking at this risk and return, and that doesn't really compute very well. I mean, this one isn't spectacular, but at least it's above some of these other returns. It's the highest return, it looks like 12.81, but you can see there's a whole bunch of risk there. So I guess the point is just when you see something like that, unless you're a risk seeker, you probably want to turn around and run the other direction and look for something else. So, you can get U.S. common stocks and Canadian stocks. There's some risk there, but decent returns. Okay, so just again understand what risk is. Normal distribution, so you'll have to know a little bit about this. So standard deviation, so once you get 1 standard deviation from the mean while you're here or here, right? And then there's a probability, you're going to be in here. There's a 68% confidence interval. You're going to be in this range, right? So this range here. Okay. All right, so if we want more confidence, well, we're going to have to add another deviation. So we go out to 2, and we're at 95%. So a lot of times we're working a 95% confidence interval, and you're feeling, this is I'm 95% confident my return's going to land in between these 2 points here. So 2 standard deviations, and it's not precisely that, but it's close enough. Okay. And if you really want to get, but of course, every time you add more variability, you're just widening out the distribution. So yeah, you can say, well, I can be 99% confident it's going to be somewhere in here, but there's a big range. Okay. And I don't know the book talks about it, but you'll hear maybe talk about tail risk. And thing is, do I care if my returns are up in this end? Well, if I like higher returns, I'm very happy to be on this side of the bell, right? When we talk about the bottom curve or the curve risk or the distribution risk, we're talking about the possibility of being below those expected returns. So tail risk is this area down here. Of course, I mean, you can't lose more than your entire investment. I mean, this in theory goes to infinity, but the most you can lose is 100%, right? You can't, your return can't generally be greater than that. I mean, you could have multiple positive years and one big negative, but once you get to zero, you can't lose any more than that, at least in a common stock. All right. So you do need a little bit of understanding, a little bit of remember a little bit of what you did in stats on a normal distribution. And I think if you can remember these probabilities, the 68, the 95, the 99, just remember the number of standard deviations from the mean, then I think you're going to be okay. Okay, so again, when we're talking about returns on stocks, I mean, this doesn't look perfectly like a normal distribution, but generally, if you look at a big enough sample, it's gonna generally look like a normal distribution. Okay, I want to talk about this. So I posted a discussion problem for chapter 12. So it's a shorter problem. Basically, you want to calculate the arithmetic average, geometric average, and then a discussion explaining what the difference is between these two. And we'll get to that here. We'll look at a problem here looking at that. But don't forget, so this chapter, there's a discussion question. And again, that counts for marks. So you don't have to comment on other people's. You just can answer it. And that's all you need to do for this one. All right. So arithmetic average, I think you all know what that is. You add them up, you divide by the number of observations, and that's pretty straightforward. Okay. And so this is going to go through the example and the calculations, but I think it, again, we'll do a problem. I think it's better when you actually see it being done. So, you add up the returns. So if it's a negative return, of course, you've got a negative here. Looks like they have another negative here. And they've got an arithmetic average of 5.2%. Okay. All right, so I think we're all pretty comfortable and familiar with that. What metric return does is it looks at the impact of compounding. So with a few minor exceptions, unless returns are identical every year, the geometric return is always going to be less than the arithmetic average. So all this is doing is it's considering the impact of compounding on periods, whereas arithmetic average is a simple average, right? So to do this, we basically need to look at, well, we need to calculate each return for each year. We in decimal form, we add 1 to it, and then we take the root of that. So this is sort of a long way to get to where we're eventually going to go with that. And so this is our equation here. Just note that you're taking the root. So if you have 5 returns, you're going to take 1 plus the return in decimal form. If it's negative, it's going to reduce it. So 1 plus negative 10.10 is 0.9, and so on, right? If you have a 15% return, it's 1 plus 0.15. And then you multiply these together, and then you take the root of the number of observations. So t is your number of observations or your time. And if you had 5 observations, you take the 5th root. And before you're finished, don't forget to subtract 1 here on the end. All right, so here you'll see a comparison. So here we see arithmetic, geometric, and standard deviation. So standard deviation is going to be based on the arithmetic mean. And you can see that these are all lower than the arithmetic. So the geometric is always going to be lower than the arithmetic mean. In most cases, unless all the observations are equal, then I guess they would be the same. Okay. Capital market efficiency. So the idea is that markets are efficient. Information that's publicly available moves very quickly. Generally, markets aren't as efficient as we'd like to think, I guess. tends to be this, in an efficient market, new information comes out, boom, everybody knows about it, the price adjusts instantly. What typically happens is information circulates, people, investment analysts are aware of it, and then it becomes public, and you might be doing something else instead of looking at a screen investing. People hear stuff and they tend to overreact, then things sort of come back down again. And it works the opposite way. You get some bad news and people go down here and realize, well, it's not quite as bad as we thought, and so on. So the idea really of this is that if markets were extremely efficient, then you'd have this arrangement here. Because they're semi-efficient, you have more of this dotted line where it slowly corrects to the appropriate level, and you get this overreaction and correction often. A lot of emotion in investing sometimes. Okay, well, what makes markets efficient? Well, yeah, all the information is publicly available. Okay, somebody's researching these stocks, so I mean, somebody's doing this work, so they're probably not doing it just for the fun of it. So you're paying someone to invest for you, or you're spending the time yourself to do this analysis, or you're paying for the information, I guess. Okay, so the efficient market hypothesis. So they come down to really there's three different forms of market efficiency in the efficient market hypothesis. So again, the idea is that you're going to earn a return appropriate for the level of risk you're assuming. So all the information should be reflected in the asset price. The risk you can at least estimate it, and again, we'll talk about diversification a little bit in the next chapter. Again, the idea of you're not going to put all your money in cannabis stocks, or you're not going to put all your money in tech stocks, and we'll talk about how diversification helps with that. Okay, strong form efficiency. So this is the idea that all information, public and private, is reflected. While private information shouldn't be reflected, because then you'd be trading on inside information. So we can safely assume that we don't have strong form efficiency. Semi-strong is the idea that all publicly available information is reflected in the prices. So press releases, if you watch the business news every day, if you have a ticker on your computer and you're watching things, you're going to see the news as it becomes available, and the market should react pretty quickly to that. Okay, and this implies that fundamental analysis will not lead to abnormal returns. So it's saying that all that analysis is already reflected in the share price, so there's no point doing it. Okay, so probably not entirely true. Weak form efficiency, this is the idea that the past reflects the future. So this is the idea of technical analysis. So when you see those cool graphs and drawing lines and charts, that's technical analysis. And that's saying that if the market is weak form efficient, then technical analysis will help you in some respects. So there's still lots of people that read charts and follow charts. It's not the mainstream. Fundamental analysis tends to be where most of the analysis occurs, but there's a good chunk of people that are still seem to be doing okay with technical analysis. And so the evidence generally suggests that markets are weak form efficient. So somewhere between weak and semi-strong, but probably more on the weak side. Okay. So this is saying that even technical analysis will not lead to any abnormal returns. So, but again, investors are doing it. So I have to think there's something to it. Okay, well, like I say, I think it's good to read through that chapter, the history part of it, at least understand relatively where returns fit in, and how this stuff all comes together. And so now we'll look at a few problems here on the chapter. So I'm just going to bring up the book here, and we'll have a look here. Okay, so we're on page 462. 462, and we're going to look at question 1, calculating returns. So I know it was before the break when we sort of looked at this, so um, give you a minute to look at question 1, and then we'll see how we can tackle that one. Okay, so this is the HPR, holding period return. So normally annually you're going to calculate return. If you're an analyst or you have your own portfolio, you're probably going to go through each individual holding and calculate a holding period return, and then weight your portfolio and find out your overall return. Okay, so what have we got in question 1? So we have a stock, has an initial price of $79 per share, paid a dividend of $1.45 during the year, and had an ending share price of $88. Compute the percentage total return. Okay. So we can, P1 is our ending price, so whatever period of time, usually yearly, we're looking at. So we have $88. At the beginning of the period, or when we purchased it, whatever it is, it was $79. And we've collected a dividend of $1.45. So that's part of our return too, right? And then we divide that by our initial price. Okay, so we calculate this and we'll get a percentage return. Well, we'll get a decimal, but we express that, multiply that by 100, and then we have a percentage. So we have 88 minus 79 plus 1.45 in our dividend. So I have $10.45 here. And I divide that by $79. And I have a return of 0.1322, or in percentage terms, that's 13.22%, right? Okay, so nothing too difficult with this. Oftentimes you want to split up the gain from the dividend yield. So the gain here, capital gain and dividend, I think we talked about that when we were looking at dividends. So the capital gain yield is the $9 over the 79, and the dividend yield is the $1.45 over the 79. I know it doesn't ask for this, but I think some of the questions you have on your assignment, we'll look at that. So again, so your capital gain, your growth yield, 9 divided by 79, so 11.39%. And your dividend yield, of course, is usually much lower, well, generally, and 1.83%, something like that. And allowing for a bit of rounding, I think that up to pretty close to 13.22%. And I think it does. So all we're doing is we're splitting out capital gain yield, what's the growth in the company, what's the share price appreciated, and the dividend yield. So these are both percentages and percentage there. Okay, holding period return. So you should be comfortable doing that. You can do this one. Oops. P1 plus D0 over P0 minus 1. That'll give you the holding period return. But if you need to split it out, then you're probably better to do it the other way. But if you take the 88 and the $1.45. Okay, well I'm glad it looks a little easier now. That's good. So if you take the 88 plus the $1.45, you don't need a decimal there, I guess. Over 79. And oops, subtract 1, you'll get the same number, of course. You'll get the holding period return. So you're getting, I can probably do that in my head, 89.45 divided by 79. And I get 1.1322, so I subtract 1, and I get 13.1322, or 13.22%. Okay. So either way is fine. I mean, sometimes there's an advantage to splitting it up. Just remember to subtract 1 if you're going to do it this way. And this is going to give you the entire holding period return and doesn't break it out as nicely as the first problem there. Okay. Any questions on that? Looks. All right. So the next few questions, and some of these are on your assignment, so the next few are somewhat similar to that. So nominal versus real return. So just remember to use the Fisher formula, the actual exact one. If you run it, if you're not getting the answer you're expecting, make sure you're using the Fisher formula. Not the approximation, but the exact method. So the approximation was, well, inflation, or sorry, the nominal rate, so the total rate, the posted rate is equal to the real rate plus inflation. And the exact method, you're adding 1R here. And so this is more precise. And when you're doing the calculations for nominal and real rates or inflation rates, use the exact method for the Fisher effect, because you'll be out enough here that it's going to tell you have a wrong answer. So it's a good approximation, but when you're doing the assignment, make sure you're using the exact method for the formula. All right. Okay, so we're going to look at question 7, and I did up a worksheet. It's posted on Blackboard, so you'll see that at the bottom of the module in chapter 12. And so you've got two stocks here, and X and Y, and what do they want you to do? They want to calculate the arithmetic average and the variances. I don't really know that the variances do much for you, but you need that to do the standard deviation if you're going to do it by hand. And I'll show you how to do it on the calculator because I don't know that you want to do these by hand very badly. And you can do it on your BA2. And I think in the video, if you were looking at that, there's a way there to do that as well. All right. Okay, I'm just going to show you in Excel how this would look, and I appreciate, you're not going to be doing that on an exam, but this is the worksheet that you've got posted in Blackboard, so you have this Excel sheet, and you can go ahead and use this sheet, use new numbers, and calculate it, but I'll show you how to do it on the calculator. I don't think, you're not going to, the exam isn't going to turn on calculating standard deviation, so. But I think you need to understand confidence intervals and returns and just how finance assesses and measures risk. Okay, so let's look at question 7. Well, let's read what it says, I guess, before we dive in here. I guess there's really mostly data, so 5 years of returns. We have a stock X and stock Y. Note we have a negative return here. So 1 year of negative returns. And so I'm going to put this in Excel, or I have done this. So this is stock X and Y. Trying to line that a little better, but maybe I won't worry about it right this moment. Okay, so X and Y, so you average here, so that there is an average function in Excel. You could add them up and divide by 5, and you should get the same answer, right? Also in Excel, there is functions for variance and standard deviation. I mean, if you're going to use a spreadsheet, you can jump right to standard deviation, I would say, but it just shows you the relationship. So the function var.s just means you're using a sample, so the .s means you're using n minus 1. So you have a sample, not the whole population, which is typically the case. And you can do the same thing here with standard deviation .s, so stdev dot s is the standard deviation for the range of data above. All right, so there we have our standard deviation and return. All right. This square root is just taking the square root of this number and just confirming that, yeah, square root of variance is standard deviation. So if we had any doubt, we can rest easier now. Okay. Getting a little choked up. I'm so excited about this stuff. So let's, it is good stuff. So X and Y. So let's try with a calculator. Just so I did the exact same thing here, and you can double check these if you like. But I'm going to just use the calculator. I don't know if any of you use the calculator to calculate standard deviation. Expectant stats, it's pretty Excel intensive would be my assumption, but maybe you maybe on the exams and things, I don't know if they have you do it with your calculator, but we'll just show you how to do it here, so you know. But if it's in those videos on the BA2 Plus, I think there's a section on calculating stats, and it probably isn't a bad idea to know how to do it. I mean, it's a lot easier than doing it by hand, I guess. So that would be my advice. But I'm just gonna bring up the calculator here, and we'll just do one example here. We'll do Y and just make sure we're getting the right answer. And I think we will, but let's make sure. I'll find my calculator here. It takes a little minute here to think about it. So, yep, doesn't. All right, well, I'll leave it here so that we can see what we're doing. And so again, you want to second clear everything, and we're not doing cash flows today, so I'm not going to worry too much about that. So anyway, let's just go back here. And I'm going to just enter data. So I'm going to enter the data for Y, stock Y. So I have 5 years of data. And so I'm just going to go into the data function here, which is just above the 7. So if you go second 7, Um, and I think sometimes there's different. Okay, well, I guess it's already set, but sometimes if you go into second stat, there'll be different areas. So data is data. Um, you can enter X and Y. I'm gonna enter Y X, but it's really Y is what I'm looking at. So I don't have two variables at the same time that I'm trying to do something with. So everything is X. Okay. So I have 21%. So I'm just gonna enter 21, enter that. I don't have any Y, so I'm just gonna leave that. 36 is my second observation. And these are percentage, so it doesn't, as long as we're consistent. Okay, I don't have any Y variable. 13% for 3, variable 3. Okay, again, and then negative 26, so just don't forget the negative here. And enter that. And on to number 5 is 15%, so 15. Enter, and down arrow, and I'm done. All right, so we got the data entered. Now we can go into the stat function. So if you go second stat, and we want to go into, I think this will work okay. Usually it's supposed to just be one variable, but so n is 5, x bar is 11.8, the mean, so that looks good. Sample standard deviation, so the little sx, that's the sample. And so 22.972, and that looks good. And that's really all we're generally going to be interested in. This is for the population, sigma, and we don't, we didn't have we weren't doing regression or anything, so we don't have to worry about y. So anyway, it calculated all those for us. So that's really all we're interested in. Sx, which is the sample standard deviation, and of course the mean, which you can probably do just as quick by hand. Okay, so that if you want to, I think it's good to know how to do this. If you had to calculate standard deviation, you had 5 or 6 observations, I think it's probably good to know how to do it on a calculator. So has anybody done that or familiar with that? Or I don't want to, if you all know how to do this, then that's great. And I don't know what they do in stats these days, if it's mostly Excel or mostly on your calculator. All right. Okay, well now you know, right? So, okay. Use the tables. Okay. All right. Well, we won't be doing much of that, so you can relax a bit. Okay. Yeah, well, you can certainly do it by hand. So on the slides. Okay, so yeah. So anyway, that's another use for your calculator if you ever find yourself needing to do standard deviation. It's a good tool to have to know how to, when you got it all there, you might as well use it, right? Okay, is everybody okay on that, on the steps? And I'm not gonna belabor it here, but you can check these or you can use this spreadsheet for your assignment if you want to do it that way and plug in your observations, and you might have to modify your formula a bit if you have more than 5 or I guess less than 5. Okay. Oh, yeah, I'm sure it is. Yeah, we don't get too crazy here with stats. I mean, you can in finance, but we don't get too bogged down in it here. So if you know if you got through stats, okay, you'll be in fine shape. So okay, all right. Well, we'll come back to 17. So on this spreadsheet, there's another question here with 17 on confidence intervals, and I updated the file today because I think they put in a new table and some of the data changed slightly, but not a huge change. This has been updated, so but we'll look at that in a minute. I want to look at now is question number 15. And I don't think you had any on your assignment on arithmetic and geometric returns, but you do get the opportunity as well on the discussion problem to do that one. And it shouldn't take you very long. You just have to post your answer to both, and you're good to go. Okay, so we're on question 15. I think 16 is a little longer and more involved. You got to calculate holding period returns and then calculate your averages. So, all right, so 15 we have we're going to calculate arithmetic and geometric returns. So we have looks like 6 years of data, and we want the arithmetic and geometric returns on the stock. All right. So this is question 15. Somewhere around 463, I think, is the page number. I believe. Yep. 464, okay. Yeah, a little bit ahead of where I thought. Okay, thank you. All right, well, let's just list out the data. So we got, these are just percentage returns. So 9, 21, 32. So percentage, right? Negative 18, 27, and minus 12. Okay, so arithmetic. And I'm pretty sure that you're all pretty capable of doing this without any trouble. You add these up. Just make sure you're adding a negative, so I'm just subtracting it. And divide by 6, right? And there's our average. Okay, so give you a minute to do that in your calculator. I know it's nothing you can't handle, but hopefully, I guess it helps if I copy the numbers down right too. Does that look right now? Okay. So I should have got 59, and I'm going to divide that by 6, and Brent's got 9.83, and I would agree with that. Looks good to me. Okay. And so does Joy. Okay, well, that doesn't look so bad, right? You get 50 years of data, and you can calculate your arithmetic average and your standard deviation if you want. And probably, like I say, you probably want a spreadsheet or something besides a piece of paper and a pencil to do that. But all right, well, what about geometric? So geometric takes into consideration the compounding factor, right? So there's a simple example we'll maybe look at next time if we have a chance. Just to compare arithmetic and geometric, there's a very simple case where we can show that why geometric may be more appropriate. Sort of the general rule is arithmetic average. If you're looking at 60 or 40 years of returns and you're just trying to collect some data, arithmetic is fine. If you're looking at your portfolio and you're retiring in 4 or 5 years, you might want to be a little more precise and look at a geometric average. Okay, well, let's see how we're going to do this. So this gets a little more involved. We're going to take convert these all to add 1 to all of these and convert them to decimals. So 9% is 0.09. I'm going to add 1 to that. 21% is 1.21. Okay. 32% is 1 plus 0.32 or 1.32. Okay, now I have 1 minus 0.18, right? So I have 0.82, right? So I'm always adding 1 to this, convert it to decimal, add 1. 1.27, okay, and we have 12, so I have I have 0.88, my last one, okay, and I'm just adding 1, so I'm just going to make this consistent, and this is 1.09. All right, and so I'm going to multiply these all out. That's my first step. I'm going to take the root of the 6th root, because the n is 6. I have t is my time. I have 6 years, so 6th root, and then don't forget to subtract 1 at the end. Okay. All right, does everybody feel like they can handle that on their calculator? Oop, it vanished. Now it's in my way, so I'll slide it over here a bit. Okay, so go ahead and do it. If you stuck, I'm just going to start entering here 1.09, and I'm multiplying that by 1.21, and multiplying that by 1.32. I'm sure your fingers are quicker than I am with the mouse. 0.82, and 8, and 1.27, and 0.88. Okay. All right, so if I did that correctly, did anybody get the same answer, 2.545? We'll find out here in a minute if that's correct or not. All right, so I want the 6th root of this thing that I just multiplied out, so I'm going to go y to the x and 6, and I want the 6th root, so I want the reciprocal, so 1 over x is the 6th root, okay, and I get okay. So I made a mistake. Yeah, I know it's not 16.84%, so I think you guys are good to go. Let me do this again. I must have messed up here somewhere along the piece, so I'm a little better with my finger than with my mouse, but 1.32. Yeah, I shouldn't get a number that big when I just keep multiplying these. So, uh, okay, this one looks a little better. All right, how does that one look? 5955. Okay, I think that looks better than my last number. Okay, that one. Okay. All right, well, let's try this again. So I obviously messed up on my entering numbers. So So y to the x, and it doesn't really tell you anything that it's done anything. And it's 6, but we're not taking it to the 6th power. We're taking it to the 6th root, so that's 1 over 6, and equals this, and subtract 1, right? All right, so I should get 0.08097, 0.08097, or 8.097%. Okay. All right. Okay, does that look like a number that most people got? Now that I have the correct number there, I hope. I guess they rounded it to 8.1%, so that's fine too. Okay. Yeah, so it's not difficult, but I mean, messing up when you're entering numbers is probably the biggest thing. So take your time, multiply it out, write store the number if you think you want to, if you're not sure about the exponent. Make sure you're taking the 6th root, not the 6th power, subtract 1. And you should always get a number that's less than your arithmetic average. So, and that's, it's actually quite a bit lower, but you got a lot of variability here. You got some big returns and you got some stinkers in here. So the compounding impact, so the 8.097 versus arithmetic average up here. Okay, so if you're looking at 60 years of returns, I think arithmetic average is fine. If you're looking at a shorter term, your own an individual portfolio, somebody that's getting ready to retire, then maybe geometric is better. But the short description is geometric considers the compounding impact, whereas we don't see that with the arithmetic average, right? But okay. All right, is everybody okay? Is everybody okay there on the geometric average and the arithmetic? All right. Well, let's have a look here at another problem then. Okay, so I think you should be good here. This isn't on your assignment. It takes a while to grind through this one, but if you want some practice with holding period returns and geometric averages, that's a good problem. This is the one we just did here. Lots of these on calculating returns and variability, and I think a few of those are on your assignment as well. So if you want to use your calculator for that, and if you have any questions or problems with that, let me know. Okay, well let's look at sort of a confidence interval type of problem, and it's not difficult. I mean, if you got through stats, this isn't gonna be too difficult for you. And if you you didn't have to ace the class if you got through stats, and you probably anything we do here won't be too overwhelming for you, I don't think. Okay, well let's look at question 17. So this is looking at confidence intervals. Um, this one you're not going to have to worry about a normal distribution and the probability of a return being below something. I wouldn't worry about that, but that you can do that. So if you have all the tools here to do that, but we'll just look at it because we do want to be comfortable with confidence intervals. Okay, so anyway, we have returns on a long-term corporate bond. They're normally distributed based on the historical record. What is the approximate probability that your return on these bonds will be less than negative 2.2% in a given year? Okay, I wouldn't get too hung up on that part, but this part we should know. What range of returns would you expect to see 95% of the time? what range would you expect to see 99% of the time? Okay, so that's sort of your cue that you got these confidence intervals. 95% is two plus or minus two standard deviations from the mean. 99%, you've got a wider range, plus or minus three standard deviation. Okay. So again, in that same Excel sheet, I just did a little bit here with that. This is referring to table 12.5 on page 452 in your book. So it's giving you the average return on long-term bonds, which is 8.37%. And it's giving you a standard deviation here of 9.58%. All right. We'll come back to this probability of it being less than this in a minute. So this part I wouldn't lose any sleep over. If you know how to do it, that's good. If you don't, you're not gonna miss it in this course. But this part is important, and I think it's relatively easy. Keyword relatively, I guess. Okay, so let's look at a 95% confidence interval. So all I'm saying is, well, my average expected value was 8.37, and at 95% confidence, I'm going to be plus or minus two standard deviations from the mean, right? I could either be above it or below it with equal probability. Okay, so my standard deviation is here. My mean is here. Okay. No, you don't need to memorize it. It's just a number given in a table, and it's just to answer this question. So, no, don't memorize these averages. These are things you can look up if you ever need to know them. So you won't have to remember anything like that. Okay. Yeah, if you got a question like, yeah, definitely. If you were asked for a confidence interval, it would give you an average return. It would give you a standard deviation. So you're definitely going to have both these numbers, and all you need to do is know that, okay, well, if it's 95%, it's plus or minus two standard deviations from the mean. So I'm just plus 2 times this, minus 2 times this. And if you remember confidence interval, I'm 95% confident that my bond return is going to be between negative 10.79% and positive 27.53%. That's my range, right? So this is my confidence interval, which is, yeah, it's a range of, based on a 95% probability, it's going to be somewhere in that range. Okay. And I'm not overly concerned if it's above it. Like when we talk about tail risk, I'm only worried, I'm not concerned if I get more than that. I'm quite happy to take more, but I'm worried about the lower tail risk, that negative 10.79 is the worst I should do 95% of the time, right? Doesn't mean it can't. 5%, I could have something else, could be worse, right? All right. And so if you look at in these I just have the numbers in this formula here, so nothing too complicated. I'm just doing what it said here in the notation. And then the same thing here at 99. So 99% confidence interval. Well, I want to be more confident, but I'm going to have a wider range. I'm going to have 3 standard deviations here. So 3 times 9.58, add that, 3 times that, add it, 3 times that, subtract it, and I get a confidence interval here. So this is a 99% confidence interval. That's going to be between negative 20.37 and 37.11 on the high end. Okay, again, I have a higher confidence interval, but I also have a much range. I mean, there's like a range of 57%. I'm not very concerned if it's 37 above the mean. Even if it's 2 above the mean, I'm probably okay. But if it's minus 20, I'm probably not feeling that great at the moment. Okay, so just make sure you understand this part of it. The rest that we're going to talk about next isn't critical to anything that you need to know. If you remember looking at your Z distribution and your tables in stats, you can do this, or you can use Excel as a function to do that as well. But make sure you know how to do all this that is here, right? So that you should know. That's you're expected to understand that. Those three, you've got it. That's all you need to know. You'll be given these numbers if you ever have to do something like that. Okay? All right. So is everybody okay with that? So I want to make sure that you're comfortable with this. I don't think this is terribly bad or difficult, but make sure you can do this and understand it. Okay? All right. Well, let's look at the next part of this. How do we use the sixth root in the calculator? Okay, well, that's a good question. I don't have the actual number here, but it was, let's say it's 1.55 something. So you take y to the x, so your normal exponent key, and it doesn't really tell you that it's done anything. And so 6 would just give it to the sixth power, but I want the root, and 1 over that is the root, right? So then I hit right above it is 1 over x, and so if I raise it to this power, 0.16667, that's the same as taking the sixth root. Okay, so I press equal, and I get that number. So that's the sixth root of that 1.55 number. Okay, does that help you out? So exponent key, right above it is the reciprocal key, 1 over x, and to do the root, you just flip it, and you're good to go. Okay. So if it was the fifth root, I mean, you do, just the same thing. Does that answer your question? Okay. Okay. If you're stuck or need help, let me know. I can go through it with you. The video does go through it. So the BA2 plus videos do go into the stats functions, and why don't even the basic one, I think they talk about using the exponent keys, so you don't have to delve into the stats area to get there. Oh, okay. Yeah. All right. Well, let's continue on. Any other questions before we move on to this part that I would say is optional? So if you uh, eyes start glazing over, don't worry about it. It'll be temporary. Okay. Well, let's look at this first part of the problem. Suppose the return. Okay, well, we already know that. Based on the historical record, what is the approximate probability that your return on these bonds will be less than negative 2.2% in a given year? Okay, well, I mean, if you're an investment advisor and your client, I mean, everything's a probability. You don't have a perfect crystal ball, but you can, they want to, well, what's the chances that I'm going to earn less than negative 2.2% in any given year based on this information? Okay, so an average return of 8.37, standard deviation of 9.58. All right, well, if you go into Excel, there's a normal distribution function, and so it needs the x value or the observed value here. It needs the average, and it needs the standard deviation. If you want a cumulative probability, you put true in there. I won't pretend to be an expert using this formula. I usually use tables. Um, I can't say it. I don't probably do it that often, but when I do, I probably use a table. But Excel has the functionality there, and so you can come up with a probability of 13.49%. So the chances of earning a negative 2.2% or greater, so it's in that tail on the bottom, is 13.49%. So if you think you can live with that probability, then you'll probably be okay. All right, if you cut, and I think with you use the Z value, so this is the Z value, so you take the negative 2.2 minus the mean, and you get a negative 10.57. Divide that standard deviation, 9.58, and you get a Z value of negative 1.1033. And if you go to your table and on a one-tailed test and look at that, yeah, I think you don't get exactly this. I think you get 12.8 or 9. So probably this is a little more accurate than the table, but that's the Z value. And if you didn't like any of this, you can uh, erase it from your mind as long as you're good down here. Okay. All right. Is there any questions on any of that? Okay. So confidence intervals, have those nailed down. Know each three of those probabilities for each of the, one standard deviation, 68 to 95, 3, 99. You need to have that buttoned down. All right. Okay. Let's see what else. See if we can find another one here to look at. Trying to find one where we don't have to dig around in a table too much. Well, let's just do 9, but this time let's do the geometric average. So just take the data from question 9, and all we're going to do is the arithmetic and geometric average returns. Okay, so we're not going to answer well, I guess it asks for arithmetic average, but don't worry about the variance and standard deviation. So question 9. We have 7%, we have negative 12, we have 11, we have 38 and 14. Let's just see if we can calculate the arithmetic average and the geometric average return for that. Looks like a 5-year period. Okay, so just do this here. So question 9, calc. And 7 minus 12, 11, 38. And our last one was 14. Okay, so I'll give you a few minutes to look at this one. I know the arithmetic average isn't too bad, but the geometric, takes a little bit of time, and you gotta punch that in your calculator. So we'll give you about 5 minutes, and we'll come back and check in and see where we're at. I'll be here if you need anything. Okay, looks like we got some answers rolling in here. 11.6 arithmetic and geometric 10.46. Sheldon agrees, and so does Joy. All right, so yeah, if I add these up and divide by 5, I get the same answer, so I'm feeling pretty confident in that. 11.6%. Okay. Well, let's have a look at the calculator, and if I don't mess up with my fat fingers here, we'll see if we can get through this. Okay, so I have 1.07. Multiply that by negative 12, which is 0.88. 1 plus 0.12. Negative point, well, 1 minus 0.12, I guess, 0.88. Multiply that by 1.11. Okay. Multiply that by 1.38. Okay. And only the one negative there, I guess. And 1.14. Right? Okay, 1.64427. All right, and how many? We have 5 observations, so n or t is 5. Okay, so I'm going to go y to the x to the 5th power, but I want the 5th root, so I'm going to go 1 over x, 0.2, and I get that, and I got to subtract 1 from that, and I get 10.46%. Is everybody okay with that? Okay. And it's less, it's more than a percentage point lower than the arithmetic average. And as you'd expect, it's going to be lower, right? Okay, so make sure you're comfortable with both the arithmetic, and I'm sure you are good with that, but the geometric is probably new for most of you, or a lot of you anyway. So make sure you're comfortable calculating that one. Okay, so we'll end there for today. I'll stick around here for questions if there is any, and last minute questions, and I'll be around here after too if you need anything. So the plan Thursday, well, it's quiz day. I'll be available. I don't think we're going to do anything new in class, but if you want to check in and have questions or want to do something, we can have a look at it. Next week, we'll leave Tuesday for review, so hopefully some questions come in, go through the practice exams and so on. Those are available now on the menu pane. You'll see those practice quizzes and exams. And so yeah, so you can write the quiz anytime Thursday. It's not during class. The quiz is, you have that window from, I don't know, 6 or 7 in the morning till 11 at night. Class time is open time. I'll be here. If anybody else comes, I'll ask questions. I'll answer them. But there's no new material being presented. Next week is the midterm on a week from Thursday. And so Tuesday's class we'll be doing review and answering any questions. But if you do have questions this Thursday, I'll be happy to help you out with that. Okay? All right. So have a good rest of the day. Welcome back again. And we're sort of back into the thick of it already. I'll stop the recording here, so stay healthy and well.